We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome to the first episode of The Long-Term Investor. I'm Peter Lazaroff, and in this episode, I want to explore what it means to be a long-term investor. So to me, time horizon is the obvious one. In my conversations with other professionals, I typically hear people think of long-term as 10 years, and I can totally live with that. But when I'm making a decision in my portfolio, I'm usually thinking 20 years. And I absolutely cringe when people say 3 or 5 years is long-term because outcomes are pretty random over those time frames. Even 10 years is relatively unpredictable, but 20 years tends to be enough time to let financial theory play out. But if 20 years is our definition of long-term, then undoubtedly the long-term feels like an eternity to live through in the moment. Staying the course is one of the biggest challenges investors face. Whenever I'm talking to someone that wants to change course, whether that's selling out of stocks due to some event or fear of some event or making an allocation change in response to recent performance, I lean heavily on evidence to help them make a good decision. And the thing with making evidence-based investments is that you have to think long-term, and that's when I end up starting to talk about 20-year time periods during these conversations. And sometimes a common rebuttal I will get when I start talking about this 20-year horizon is, I don't have 20 years. But that's just not true. If you're in your 60s or 70s, you're just ignoring the probabilities if you don't think you can live another 20 years. And if you're 50 or older, maybe you think you don't have 20 years because your retirement date falls before that mark. But unless you need all of your money on the day you retire, you should be planning on having at least 20 years. And if you're under 50 years old, well, I don't think I really need to convince you that you have a time horizon of at least 20 years. And I'm really focused in on this personal time horizon at the moment, but regardless of age, I definitely see people judging outcomes of their long-term investments in what I would say is less than long-term time periods. For example, for the past several years, I've found myself frequently answering questions about owning non-US stocks because the S&P 500 has trounced it for well over a decade. And since March 2009, just about everything has underperformed the S&P 500. So this comes up in a lot of conversations. Of course, near the end of the 2000s, nobody wanted to own the S&P 500. No. The S&P 500 had a negative average annual return in the decade of the 2000s. And from 2000 to 2012, the S&P 500 actually underperformed treasury bills of all things. So back then, everyone wanted more emerging markets, more developed international too, but especially more emerging markets because China was going to dethrone the United States or something like that. Anyways, fast forward a decade and people just want more of the S&P 500 because it's doing better than everything else. And nobody wants emerging markets now that it's underperformed for 10 years. And look, the S&P 500, not exactly the best benchmark. And I don't want to go down that rabbit hole. That's probably an entirely other episode at this point. But when you look at the full 20-year period, emerging markets is still winning. It's funny, people forget. So if you're evaluating the validity of being a globally diversified investor, that 20-year period ought to begin whenever you started. So if we're evaluating something, it's not give it another 20 years. It's let's finish out the 20-year period. So if you invested in a globally diversified portfolio in 2015, then here in 2021, it's only been 6 years. Maybe you ought to wait another 14 years before deciding to only invest in the S&P 500. If you're thinking about making a change to your portfolio, I think you need to be making that change with the multi-decade horizon. So 20 years to me is really just the starting point for the long-term investor. There's an example that I often cite from Warren Buffett that I love, and he talks about this 20-slot punch card. And anytime in my role as Chief Investment Officer at PlanCorp, where we're managing nearly $6 billion in assets, I like to think in context of Warren Buffett's 20-slot punch card, which I'm going to read a quote here. Quote, I could improve your ultimate financial welfare by giving you a ticket with only 20 slots in it so that you had 20 punches, representing all the investments that you got to make in a lifetime. And once you'd punched through the card, you couldn't make any more investments at all. Under those rules, you'd really have to think carefully about what you did, and you'd be forced to load up on what you really thought about. So you'd do much better, end quote. So to me, a big part of successful investing is avoiding mistakes. And this long-term framework of the punch card, it reduces the opportunity for performance chasing or reactionary moves while highlighting only your best ideas. But equally important, the framework emphasizes a patient process and a long-term mindset. So I'm really hitting this hard. I think the long-term investors should make investment decisions in the context of a multi-decade time horizon. And I've thrown out 20 years, but realistically, why not 30 or 40 if you can justify doing so? And the long term is going to feel like an eternity to live through in real time. And the basic pieces of financial theory may appear broken over any given market cycle, but they tend to shine bright when you allow them enough time to work. So the obvious part of being a long-term investor in my mind is having a long time horizon. In part because financial theory tends to work over the long term, but why else? Well, time mixed with the power of compounding is the most potent combination for wealth creation. Compound interest isn't linear, it's exponential. And the human brain just isn't great at visualizing exponential things, which may explain why it's so difficult to fully appreciate a plan that fully leverages the power of compounding. So let's try to fix that. Imagine you take a sheet of standard printer paper with a thickness of 1/10 of a millimeter. You fold it over once, and now it's twice as thick. Fold it again, and you've doubled the thickness of the paper again. 2 folds makes the paper 4 times as thick. Fold it a third time, and now that paper is 8 times as thick. If you could fold that piece of paper 50 times, believe it or not, the paper would stretch 95 million miles, or approximately the distance from Earth to the sun. And at 100 folds, it matches the radius of the universe. And I did the math in an Excel spreadsheet. It totally blew my mind the first time that I stumbled into this. And look, unfortunately, it's impossible to fold a piece of paper more than 8 times. Really, go ahead. I dare you, try. But the underlying math of repeatedly doubling the thickness of paper is exciting when we apply that same exponential growth to your wealth. So another great example I like to use when we're talking about showing how good planning can maximize the benefit of compound interest is Ben Franklin. So I'm going to give you the quick story. Maybe you've heard it before. At his death, Franklin's will left 1,000 pounds of sterling, then worth about $9,000 US, to his adopted home of Philadelphia and his native city, Boston. And Franklin wanted the trustees to loan the money to apprentices much in the same way he'd received assistance earlier in his career. And his will also stipulated that the interest collected from the loans should stay invested so it could compound over time. After 100 years, both cities could withdraw 75% of the funds to use for infrastructure projects that would improve the quality of life for those cities. So bridges, roads, water systems, public buildings, etc. And then in another 100 years, the cities could withdraw the remaining balance for the additional infrastructure and city betterment projects. So when Franklin did this, he had estimated a 5% annual rate of return from the loans, and it turned out only to be 4%. But even though it was marginally less than what he was expecting, the results were shockingly large. The cities made their first withdrawals in 1890. The fund grew from his initial contribution of $9,000 to $500,000 in that first 100 years. And in today's dollars, that was about $13 million. And when the cities could make their second withdrawal in 1990, they gained access to another $6.5 million, or about $12 million in today's dollars. So Franklin understood the power of compounding and knew that good planning and time were the essential ingredients to having it work in their favor. Now, you probably won't get a 100-year time horizon, but being a long-term investor should mean you have several decades to allow your investments to earn compound returns. And the way that Franklin structured his will provides a really great illustration of how thoughtful planning and time can best capture the power of compounding. The more time you have, the more your wealth benefits from the compounding effect. And that's why, to quote Warren Buffett again, he says, quote, "Life is like a snowball. The important thing is finding wet snow and a long hill." So think about it. As the snowball rolls along, it collects more snow with each rotation. And the further it rolls, the more mass it can exponentially gain. So in Warren Buffett's quote, that wet snow, it's the returns or the interest you pick up from reinvesting more interest as you roll along. And the long hill, that is the multiple decades you give yourself if you are truly a long-term investor. So once you create a well thought out plan that focuses on maximizing wealth as a means to meet your goals, you can sit back and let time do its thing. And it's not just an investment issue. Time and the power of compounding can turn small decisions and good habits of all kinds into incredible results. So when you ask and try to answer the question, should you invest or pay down debt? Where should you keep cash savings? What type of investment account should you fill up first? Should you rent or buy a home? What percentage of your income should you save? The decisions you make today will have compound effects decades later, which is why I've historically written on both investing and financial planning topics. That's what I think being a long-term investor is all about. And I also think that being a long-term investor means doing nothing more often than something in your portfolio. Because you should be active in the areas that you can control, like financial planning, but the changes to your portfolio should be few and far between. Now, one final thing I think that we ought to point out that it means when you say that you're a long-term investor is that I think the long-term investor is an optimist. During times of uncertainty, we tend to gravitate towards high conviction predictions. They're eloquently presented by people of authority or special expertise of some sort. But you have to be careful when consuming predictions of what happens next, especially when people start proclaiming doom and gloom scenarios for the future. There is plenty of research that shows us that people hate to lose money more than they like making it. Nobel laureate Daniel Kahneman and his colleague Amos Tversky coined the term loss aversion. They showed that we feel 2.5 times more the pain of losses than you feel the pleasure of gains. And this natural aversion to losses and pain makes it more likely you'll gravitate to a pessimist's outlook and think that sounds smarter and more informed. And in this age of social media and the 24-hour news cycle, you'll find no shortage of negativity to consume. But being an optimist doesn't mean ignoring the fact that things are bad and could potentially get worse. But betting against the human spirit has historically been a bad bet. And if you think things will never get better, the evidence is stacked against you. A devoted student of history knows that every downturn is different and scary in its own unique way. And the common thread in all of them is that eventually the human spirit prevailed. Now, I don't know when and why the next downturn is going to happen, but I know that it's going to happen with a similar magnitude or frequency as it has in the past. I think on average, the market's down 10% every 12 months, 20% roughly every 3.5 years, and 30% or more about once a decade. So we know that in advance. And whenever we get to that crisis, I'm not going to be able to tell you when it's going to end, but only that I know it will end. I've long believed that the key to investment success is minimizing mistakes, and believing the future will not get better for ourselves or for financial markets is a devastating mistake. It's in the periods of uncertainty that the market is going to require you to embrace fear and uncertainty in exchange for the returns you need to compound your wealth over time. So unless you need your entire portfolio to meet your living expenses in the next year, the benefit of missing some downside is far less impactful than ensuring you can capture the upside whenever it comes. But that's all I have for today. If you enjoyed today's show, please subscribe and leave me a review. And once I get a few episodes under my belt, I'll begin incorporating questions from my readers and listeners. And if you want additional educational materials customized to your specific situation, head over to smartmoneyquiz.com where you can answer a few simple questions, and then I'll send you the content of mine that's based on your responses and most relevant.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.